The petrodollar era is quietly dying in front of you. Oil is being sold for yuan, rupees, dirhams, and even local currencies that didn't matter 10 years ago. And when the dollar finally loses its throne, it won't just be a headline on CNBC. It will hit your savings, your rent, your job, even the price of your food. Later in this video, you'll see the specific chain reaction that can turn a technical currency shift into a very real-life crisis. In this video, we're going to unpack one of the biggest, least understood power structures in the modern world, the petrodollar system, and what happens as that system begins to unravel. For 50 years, the deal was simple. If you want oil, you pay in US dollars. That quiet rule supercharged America's financial power, kept interest rates low, and let the US run deficits that would destroy any other country. But now, something is changing. Saudi Arabia talks openly about accepting other currencies. BRICS countries, Brazil, Russia, India, China, South Africa, and their new partners are settling more and more trade outside the dollar. Central banks are slowly shaving down their dollar reserves and piling into alternatives like gold and yuan. Why does this matter for you right now? Because the dollar is not just America's problem. It's the backbone of global trade, the pricing unit of most energy, and the safe asset in which pensions, sovereign wealth funds, and corporations park their cash. When the backbone bends, everything built on top of it feels the strain. By the end of this video, you'll understand how a secretive deal in the 1970s created the petrodollar and made the US dollar king of the world. Why countries are now quietly rebelling against that system. What it actually looks like when a reserve currency loses dominance, using history, not just fear. And most importantly, the three main scenarios for your money, your job, and your long-term security if the dollar's throne keeps wobbling. Stay with this, because the real danger isn't a Hollywood-style dollar collapse overnight. The real danger is a slow, grinding erosion that most people ignore until it's too late. Here's where it starts to get interesting. To see why the petrodollar's collapse matters, you first have to understand how unnatural its birth was. In 1971, President Richard Nixon did something radical. He severed the dollar's link to gold. For decades, foreign governments could swap dollars for gold at a fixed price. After Vietnam, huge deficits, and inflation, the US couldn't keep that promise anymore. The gold window slammed shut. Overnight, the world had a problem. What gave the dollar value now? Foreign governments held mountains of dollars from trade. If those dollars lost trust, the whole post-World War II financial system could unravel. So Washington went looking for a new anchor, and they found it under the sands of Saudi Arabia. In the early 1970s, US officials cut a series of deals with the Saudi royal family. The terms, in simple language, Saudi Arabia agrees to price its oil only in US dollars, recycle a big chunk of those dollars back into US Treasury bonds and US assets, use its influence to push the rest of OPEC to follow the same pattern. The United States agrees to provide security guarantees to the Saudi kingdom, sell advanced weapons and support the regime, protect the global flow of oil, especially through choke points like the Strait of Hormuz. In other words, oil would be priced in dollars. Those dollars would flow back into US bonds and banks, and the US military would quietly guard the whole system. That's the birth of the petrodollar. Not a natural free market outcome, a strategic geopolitical deal. Think about what that means. Every country that needed oil, which is basically every industrial economy on Earth, had to get dollars. To get dollars, they either exported goods to America, borrowed in dollars from US banks and markets, or sold their own currency to buy dollars on foreign exchange markets. This created a constant, reliable global demand for the dollar, no matter how much of it the US printed. And here's the crucial part for your life. Because the world needed dollars, the US could run huge deficits, keep interest rates lower than they otherwise would be, and still remain the center of the financial universe. American consumers enjoyed cheap imports. US corporations could borrow cheaply. Foreign elites parked their savings in safe dollar assets. So when people say petrodollar, they're not just talking about oil. They're talking about an entire architecture of power, Oil flows, dollar demand, US debt demand, US global dominance. But every empire and every system has an expiration date. Now that you see how it started, here's where it gets even more surprising. The petrodollar didn't just dominate oil. It spilled into everything. Imagine the dollar as the operating system of global trade. Once oil ran on $OS, other sectors naturally followed. Commodities like copper, wheat, and soybeans priced in dollars. Shipping contracts, insurance, and global loans denominated in dollars. Central banks from Europe to Asia holding US treasuries as their core reserves. By the early 2000s, the dollar made up around 70% of global foreign exchange reserves. Even today, after years of slow decline, it's still above half, far more than any other currency. Ask yourself, why does this matter? Because when your currency is the world's default, you get three gigantic advantages. You borrow cheaper than everyone else. Investors around the world are desperate to hold US treasuries because they're liquid, deep, and backed by the global system. That keeps yields, and therefore interest rates, down compared to what they'd be otherwise. You can export inflation. When the US prints money, a chunk of that new money gets sucked into global trade and reserves. The inflationary pressure is shared with the rest of the world. Other countries feel your monetary policy whether they like it or not. You can weaponize your currency. If the global banking system clears in dollars and runs through New York-linked channels, then cutting someone off from the dollar is like cutting off their oxygen. That's the logic behind sanctions on Iran, Russia, and others. So the petrodollar system isn't just about how we buy oil. It's about who gets to decide the cost of capital, dictate the rhythm of global growth, punish enemies without firing a bullet. For decades, it looked unshakable. But while the surface seemed calm, resentment and risk were quietly piling up underneath. Here's what nobody told you. When you weaponize your currency, you give the rest of the world a long-term incentive to escape it. Here is where everything starts to crack. The turning point wasn't one event. It was a series of shocks that made other countries ask a dangerous question. Why are we still doing everything in dollars? First, sanctions. When the US and its allies cut Iran off from the SWIFT system, and later targeted Russia's access to dollar funding and reserves, the message to the rest of the world was clear. If you cross Washington, your dollar assets are not really yours. Then came geopolitical shifts. China's rise as a manufacturing and trading superpower. Russia's pivot east after Western sanctions. BRICS countries talking openly about reducing dollar dependence and settling more trade in local currencies. Layer on top of that the Trump-era tariffs and policy volatility, and the recent second Trump presidency doubling down on aggressive trade moves and sanctions. For many countries, the dollar started to look less like a neutral tool and more like a loaded weapon. And then, crucially, the oil states themselves began to hedge. Saudi Arabia, the original pillar of the petrodollar deal, started signaling that it was open to pricing oil in other currencies. It hosted high-profile summits with China, flirted with yuan-denominated oil contracts, and joined BRICS+. Gulf states like the UAE began experimenting with local currency oil settlements and digital payment systems. Does that mean the petrodollar disappeared overnight? Not at all. Oil is still mostly priced and settled in dollars, and the dollar is still the dominant reserve currency. But the direction has changed, from unquestioned dominance to cautious diversification. Think of it like hairline fractures in a dam. The structure still stands, but pressure is building, and water is already seeping through. So what happens if those small cracks line up into one big fault line? Before we answer that, we need to look at the challengers gathering below the dam. What does all of this mean for you so far? It means the system that kept your mortgage rates low, your imported goods cheap, and your portfolio safe is no longer guaranteed. When the world slowly decides it doesn't need as many dollars, the entire pricing of risk in the US, and by extension in the world, has to adjust. Here's where it gets strange. Everyone talks about the dollar collapsing, as if one new king will immediately replace the old one. But the reality looks more like a messy, multipolar currency world. Let's break down the key challengers. The Chinese yuan, renminbi. China is the world's largest oil importer and a top trading partner for dozens of countries. For years, Beijing has been building the plumbing to trade more in its own currency, setting up yuan clearing hubs around the world, launching yuan-denominated oil futures in Shanghai, signing deals with countries like Russia, Brazil, and Saudi Arabia to settle more trade in yuan. For oil exporters, accepting yuan in exchange for crude is starting to feel less crazy and more strategic, especially when they can spend that yuan on Chinese infrastructure, weapons, technology, and consumer goods. Analysts don't expect a full petro-yuan takeover soon. The yuan is still tightly controlled, and China's financial markets are not as open, deep, or trusted as US markets. But as more oil deals happen in yuan at the margin, each one eats a tiny bite out of petrodollar dominance. Local currencies and the BRICS web. BRICS and their expanded partners have quietly pushed another strategy. Don't replace the dollar with one new big currency. Just use each other's money. Russia and China trade more in rubles and yuan. India buys Russian oil in rupees. Brazil and China settle in yuan and riel. Gulf states explore dirham and rial settlements. On top of that, BRICS is moving toward a shared digital trade token, a kind of neutral unit used only for settlement between their central banks. It's not a new everyday currency, but it reduces the need to touch dollars when they trade with each other. Every one of these moves is like a small road being built around the dollar highway. At first, traffic on the highway doesn't change much. But over time, if enough alternative roads are built, the highway loses its chokehold. Gold's quiet comeback. There's another, older challenger, gold. Central banks, especially in emerging markets, have been buying record amounts of gold in recent years. Why? Because it's nobody's liability. It doesn't depend on Washington, Beijing, or Brussels. If you're worried about sanctions, political shocks, or currency wars, gold is your neutral friend. Gold will not become a day-to-day trade currency again, but it's increasingly acting as the anchor behind the scenes. Some proposals suggest commodity-backed baskets or partially gold-linked settlement tokens for BRICS trade. This doesn't kill the dollar, but it chips away at the psychological idea that there is no alternative. New payment rails, SWIFT versus the New World. Finally, the pipes themselves are changing. For decades, the SWIFT system and dollar correspondent banking gave the US huge visibility and control over global payments. Now, China has its own cross-border interbank payment system, CIPS. Regional blocs are experimenting with their own instant payment rails. Pilot projects like mBridge are testing multi-central bank digital currency settlement platforms that bypass traditional correspondent banks. Here's the dangerous part. The more alternative pipes exist, the easier it becomes to move value without touching the dollar at all. The petrodollar relied not just on oil pricing, but on controlling the financial plumbing. That control is slipping. Now we come to the question you actually care about. If the petrodollar's collapse has started, what does that practically mean for your life? Let's be clear. This is almost certainly not a movie style. One day everything crashes and people burn dollars in the streets. What's much more likely is a slow dethroning, where the dollar goes from absolute monarch to first among many. That sounds abstract, so let's turn it into concrete scenarios. Scenario 1, gradual erosion, the long squeeze. In this path, the dollar remains the top currency, but its share of reserves, trade invoicing, and global debt keeps drifting down over years. That's already happening. The dollar's share of global reserves has gradually fallen from around 70% to the mid-50s over 2 decades. What does that mean for you? Higher borrowing costs over time. If fewer foreigners are desperate to hold US treasuries, yields must rise to attract them. Higher yields eventually mean higher mortgage rates, car loan rates, and corporate borrowing costs. More volatile exchange rates. In a multipolar system, currency swings can be bigger and faster. If you live outside the US, your local currency could see sharper moves as global money shifts between dollar, euro, yuan, and others. More frequent mini-crises. Emerging markets that rely heavily on dollar funding could face more stress whenever global sentiment changes. That can hit your job if you work in export-oriented industries, commodities, or finance. This is the frog in slowly boiling water scenario. If you're not paying attention, you only realize what happened 15 years later, when your real wages barely kept up and your cost of living quietly outpaced your savings. Scenario 2, shock event, the sudden repricing. In this path, a major geopolitical shock accelerates the move away from the dollar. Imagine a severe sanctions escalation that makes a big country dump dollar assets aggressively. A loss of confidence due to fiscal chaos or political dysfunction in Washington. A coordinated BRICS move to shift a large chunk of energy trade into non-dollar settlement. If global investors suddenly fear that holding too many dollars is a risk, you get a rapid repricing. The dollar could lose value against other major currencies. Foreign buyers of U.S. debt might demand significantly higher yields. The U.S. could face a choice between much higher interest rates or accepting a wave of inflation. What does that mean for an ordinary person? Your imported goods, electronics, clothing, fuel, could spike in price. Your savings in pure cash could lose purchasing power faster than you expected. Financial markets could swing violently as global money reallocates. This is the dangerous part. Even if the system eventually stabilizes in a new balance, the transition could wipe out the unprepared. Scenario 3, managed transition, the soft landing. There is also a more optimistic path. In this scenario, the U.S. recognizes its shrinking margin of privilege and starts to manage its fiscal and monetary policies more responsibly. It cooperates with allies and even competitors to modernize global financial architecture. The dollar remains dominant but shares space with others in a more balanced, stable way. You still feel some inflation, some volatility, and some adjustment in asset prices, but the system doesn't break. It bends. Is this guaranteed? Absolutely not. But history shows that reserve currencies can decline gradually, like the British pound after World War I, rather than vanish overnight. The pound lost its dominance over decades, but Britain didn't disappear from the map. The pain was real, but it wasn't total collapse. Key question for you, regardless of which scenario plays out, do you want to be the person who hears about these shifts only when they become a crisis? Or the person who quietly positioned ahead of time? This is the moment where all the threads we've followed, Nixon's gold shock, the Saudi oil deal, sanctions, BRICS, yuan, gold, digital payment rails, collide. For half a century, the world has run on a simple equation. Energy equals oil. Oil equals dollars. Dollars equals American power. But that equation is being rewritten in real time. Countries are asking, what if energy can be paid for in our currency? What if the banking pipes don't have to run through New York? What if our reserves don't have to be mostly in U.S. treasuries? When those questions turn into action, and they already are, the petrodollar system starts to lose the invisible magic that made it so powerful. Inevitability. And once something no longer feels inevitable, it becomes negotiable. Once it's negotiable, it becomes fragile. The collapse of the petrodollar isn't a single explosion. It's a long series of renegotiations, bilateral oil deals in local currencies, central banks cutting a few percentage points off their dollar holdings, new digital platforms that clear trades without touching SWIFT, political decisions that punish or reward countries for choosing one currency over another. The perfect storm arrives when three things overlap: a heavily indebted U.S. government that needs to roll trillions in bonds, a world that is, for the first time in decades, not forced to buy as many of those bonds, a geopolitical shock that suddenly tests who still trusts the system. In that storm, the exorbitant privilege of the dollar turns into an exorbitant vulnerability. And here's the harsh truth. Most people will treat that storm as just another crisis, like 2008, like 2020, and assume everything will go back to normal. But the deeper structural shift may mean that the old normal never fully returns. So what happens when the dollar loses its throne? The most likely outcome is not the end of the world. It's the end of a particular world. The world where the U.S. could print, spend, and sanction without worrying too much about the consequences, because everyone else needed its currency no matter what. For you, the core lessons are simple. Don't assume the financial rules you grew up with will be the rules your children live under. Don't assume that cash in dollars is automatically the safest thing you can hold. Don't assume that geopolitics is just background noise. It's directly wired into your interest rate, your rent, your wages, and your retirement. The petrodollar's collapse has already started, not as a dramatic plunge, but as a steady erosion. The question is not, will the dollar be gone tomorrow? The real question is, how ready are you for a world where the dollar is just one powerful currency among several, not the unquestioned king? If this video opened your eyes, don't let it be the last time you think about it. Because this story isn't over, it's just getting to the dangerous chapters. So, tell me in the comments which scenario you think is most likely, the long squeeze, the sudden repricing, or the soft landing. Share this with one person who still believes nothing will ever change. And if you want to follow how this plays out, from new oil deals to BRICS payment systems to central bank gold moves, hit subscribe and stay with us. The throne is shaking. You don't control the throne, but you do control how prepared you are when it finally tilts.